more on the markets, let's bring in Steve Sosnick. He is the Chief Markets Strategist over at Interactive Broker. Steve, always good to talk with you. So let's just start this morning's conversation by, like, are you thinking here about looking back at 2020 and what did we learn from that? Or is this like all right, let's figure out what we're doing next? Because the 2020 story, I guess in your mind was a simpler way of asking it. Is the 2020 story clear and obvious? And is there anything to take away from kind of how markets behaved last year?
The clear and obvious part of the 20, first of all, Happy New Year, Myles. The clear and obvious part of last year was the more risk you took, the better you did. And if there was ever any doubt to the mantra, don't fight the Fed, I think that was kind of squelched in 2020. Because basically, the more risk you took, the more you followed the Fed, the more you just dealt with the monetary stimulus and of course, the fiscal stimulus that came through, the better you were. And the further out you were on the risk curve, the better you did. I mean, you guys were talking about crypto before. Talk about being way out there on a risk curve. And you talked about crypto and Tesla in the last segment. Talk about being way out there on the risk curve. And those were two of the best things you could have put your money in hindsight, if you had the stomach for it.
Steve, consensus appears to be ahead of the Georgia runoff tomorrow that if the Democrats do in fact gain control, you could see about 5 to 7% sell-off in the markets. Would that be perhaps the best buying opportunity of the year? Look, if the Democrats get in, they do gain control. That, I would think, raises the odds of a pretty sizable infrastructure plan this year.
See, here's where it gets circular, Brian, because if enough people think in advance that it's a great buying opportunity, then the buying opportunity doesn't materialize because your chance to buy the dip is so short. It's one of these kooky things. I actually do think right now that markets are underpricing the possibility of a Democratic victory. What we're seeing in terms of volatilities, obviously we haven't opened up yet, but at least what we saw on Fridays was there was a little bit of a bump to the volatility expiring, this Friday, which encompasses Georgia and any political challenges that you get about the Electoral College. But realistically, you're seeing volatility increase more or less throughout the month and throughout the year. So there's really not a big bias placed on it. There's a little bit of downside skew, but people are actually relatively underpricing the risk of this, which I think goes back to your point that they're seeing this as, any hiccup as a buying opportunity. I don't view it that way necessarily. If it really starts to decline, yes, then you start to look for your values. But I think right now you're not seeing enough fear about this, and I think that if so much of the rally that we saw since Election Day was predicated on divided government, and we don't have divided government, well, that kind of puts the kibosh on a lot of the move we saw, unless it was, of course, just following the speculative trends and following the Fed.
Which it frequently is, Steve. We're about a minute away from the opening bell, by the way, but I wanted to ask you on this point, when we're talking about positioning, whether it's around this or other events coming up this year, we have seen a big increase in individuals playing in the options market. We saw a big increase in individuals playing in stocks generally, but in options specifically. And there was a lot of talk in 2020 about the risks from that, people taking on more margin debt. We saw the so-called Robinhood trader effect and people getting burned by that. As we go into 2021, what do we need to be aware of people positioning in options? And usually the opportunity to be burned is lower in options. That's part of their appeal. But is there still a risk there?
Well, it's an interesting one, because most of the people who are new to the options market are buying out of the money calls pretty much. That seems to be the standard trade that people are doing. Again, it goes back to the more risk you take, the better you do. You've done. Let me be clear about that. But what happens with options is, if you're a buyer of call options, you lose money slowly. You know how much you're going to lose based on each trade you go into, and your risk is defined. You can only lose the amount of premium you put in. So in many ways, it is, I hate to say a prudent way to approach it, but it's a risk-controlled way to approach very risky trades. But what happens is that ultimately you can only you're buying in many ways the worst options when you're buying these out of the money call options that expire in a week, because you're fighting decay. And I think people are very focused right now. And if you go to our website, Interactive Brokers Traders Insight, which you can see behind me, I've written about theta, and theta is decay, and these options decay, and so you're really playing the odds against you when you buy these calls. But what happens is it's death by 1,000 cuts, as opposed to, let's say, the people who are buying stocks on margin, which you see, and then then if those reverse, you owe more money than you put in potentially. So what it does is it shows that there's this speculative fever out there. It hasn't broken. It's in many ways, people have gotten lucky in many ways, and it's very dangerous if you confuse a bull market with brains. And I certainly don't want to see people lose money. That's really one of my goals as a strategist. But it's important to understand that if you're buying these risky calls, your risk is defined at the outset of the trade, but the odds of you winning decrease with each day that passes. And that's a very tough thing to get your mind around.
Steve, this reminds me of one of my favorite market quips, which is not true, and I'm sure you guys do not appreciate at Interactive Brokers, which is you can't lose money trading options. Which again, I think is sort of
I'm not going to touch that one, Myles.
There we go. Yeah. Gets at that one. Steve, I want to ask you more specifically. We've been talking around it in this conversation, but a parallel you draw in your note, this reminds you a lot of 1999. The Fed has been a part of that outline. What other similarities are you seeing there? And also, I guess serves as a reminder to folks that in 1999, the market actually did keep going up, even though things were crazy. 2000 is the year that everything sort of fell apart.
Yeah, I mean, the difference, there are so many similarities. I think the main one actually is that you had this huge sea change in the democratization of investment in both 1999 and now. In 1999 was really when people, think about people got into internet trading. And that was a big thing, the rise of E-Trade and Ameritrade, and we were not really on the radar in people's minds then. But that was a huge deal. You didn't have to call your broker; you could participate directly, more or less all the time. And now what we've done in 2020 was we've taken another step forward in terms of democratization, zero commissions. Fractional shares. These are ways that people could participate in the market in ways they never could. In terms of, and then you take things like crypto, where we left on Friday with it at 29,000. Over the weekend, when nobody's trading anything, they somehow shot it up to 34, 35,000, and then down to 28,000 and back to 31,000. So these are ways you could participate that you never could before. And I think that's maybe the biggest parallel. Also in 99, you had the Fed really goosing liquidity because of Y2K fears. Now, the differences in 2000, as you alluded to, Myles, when it came to an end, was the Fed backed off that liquidity. They realized that they put in all this Y2K liquidity. It wasn't really necessary. And that was kind of the thing that tapped on the brakes. As of now, the Fed is talking a very good game about not needing to slow down their pace of liquidity improvement, although we're starting to see inflationary pressures tick up in bond break-evens. We're starting to hear anecdotal evidence about goods inflation. We certainly have asset price inflation, but that's not apparently a concern of the Fed. And so that's really the big difference. Is in 2000, you kind of knew the party might come to an end from the Fed. As of now, the Fed's going to, they claim to be a lot slower at taking the punch bowl away while the party's having a good time, which was the classic definition of a Fed governor.
Yeah, was it Chuck Prince? Music playing, I'm going to keep dancing. So I guess we're all Chuck Prince now. Steve Sosnick with Interactive Brokers. Steve, always great to get your thoughts. Happy New Year, and I know we'll talk soon.
Very good. Thanks, Myles.